So we've had this, going for this streak, 3 in a row. Where do you think we really are now? We got, 6 weeks or so between now and the end of the year. What are we primed to do, if anything, based on what we just did?
You left the Russell out. The Russell, I think, is Russell is so critical.
I gotcha.
So the Russell's up 1% today. And I think that provides overall stability. I think markets are in a consolidation range right now. I think they're consolidating a very strong run. You have significant options expiration this afternoon. But I don't know. It's a very quiet market today. And generally, history will tell me you don't sell a quiet market. I still think there's more room to the upside. I said that with you yesterday on Closing Bell. Turn the calendar into 2024. Okay, I understand things get more difficult when you're looking at what's the economy going to do, and I think it's going to be decelerating. But this chase for performance, even if we've had the majority of gains so far, I still think the bias, the inclination is to go in and to be a buyer. And it looks like the last stage of this chase for performance is really being led by the Russell catching up to the NASDAQ and the S&P, and that's what's happening today.
All right. I mean, you make a very critical point, because I feel like, Shan, when we asked the question at the top of the show, how far can this rally go? It really does hang on that and other places, I think, other than tech. We talked about tech, mega caps so much. Joe points to Russell, which is up 5% this week. S&P equal weights up 3%. Materials up 3.5%. Industrials up 2.75%. You have to wonder whether this is the start of something. And if it is, then that bear case and the bear narrative might truly be done.
Well, I think this is what we've been talking about all year, that we've really needed this breath. And frankly, we haven't seen it, and we've been wrong, right? We continue to see the market led by what's happening in the S&P 500, by those top, 7, 8, 10 names. And so I think that in setting up a rally through and I would agree with Joe, whether we're talking about from here to year end is a different story than the first 6 months of 2024. And so I think if we continue to see that breath, what we're seeing, Scott, is we're seeing a lot of repositioning. We're seeing investors who are looking at where they want to be through the end of the year. They're looking at some of those areas of the market that have underperformed, some of those areas of the market that potentially are less vulnerable to multiple compression and actually could experience some multiple expansion, especially if we're starting to price in rate cuts next year based on some of the economic data that we have. So I think now it's more of a relative trade. I don't think people are concerned, if you will, about the names that have done really well so far this year. And I know we're going to talk a little bit about upcoming earnings there. But I think what they're doing is saying, okay, what hasn't participated? What are some of these quality companies? Where do we see some earnings growth? Where do we see companies that have exhibited strong execution this year and maybe haven't participated? Those would be nice names to have in my portfolio as we close out the year.
Bill, Tom Lee, base case, S&P to gain an additional 5%, 4,750 to 4,800 by the end of the year. Here's what Wharton professor Jeremy Siegel told me earlier in the week on Closing Bell, what he thinks we can do from here in the S&P before the end of the year. Listen.
Well, if we just take November and December and we don't see a big slowdown, I mean, we see a slowdown, but nothing that looks like it's turning into a recession. We could do another 5, 6, 7%, maybe even 10%.
Maybe even 10%. You want to take a stab at that?
Yeah, I would not be surprised, and I actually think it's pretty likely we could see record highs before the end of the year. I mean, bravo to the S&P this week. I mean, from my technical math, this is one of the most healthy consolidations over the last couple of days I've seen in a while after such a massive thrust higher that we saw after CPI and that followed through. So to play devil's advocate, because I'm bullish, everybody knows I'm bullish here, and I think it's pretty constructive. But where I'm concerned is we've seen May, from a probability standpoint, the CME's Fed Watch tool say that there's more than a 50% chance that they cut rates by May. My fear would be that gets priced out and pushed back a little bit. Look at housing starts and building permits today. Those came in a little hotter than expected. Although the Treasury market is really unchanged, yields are off the overnight lows pretty significantly. And so I'm watching the data. If the data heats back up a little bit, you start getting that probability pushed out, and that would be a concern here to halt the rally. Without that, though, I think record highs are in the cards.